Hi guys, it's Stock Curry, and after 3 weeks of declines, the market finally had a green week last week. Right now, the bulls and bears are in a pretty big fight. Who will win this year will be determined upon this data that I'm going to share with you right now. So let's get into it. Let's start with some historical analysis of the stock market. Now, historical analysis can be very helpful, especially if the market shows that it's going to repeat that history. Now, the market doesn't always repeat historical data. In fact, in October and November of last year, there were some 80 and 100-year records that were broken. Now, there's an old saying that the most dangerous phrase on Wall Street is that this time is different, which would seem to indicate that historical analysis is very helpful and important in understanding where the market might go. But we also have to understand that historical analysis doesn't hold up 100% of the time. And sometimes this time is different. And the market's already shown that in October and November of last year. Still, the data that I'm going to show you has held up so far for the first few months. So let's take a look at it and see where the market might go from here. Year 3 of a US president's term is bullish for stocks. But 2023's gain is probably over by now, at least according to the headline on MarketWatch. But as you're going to see, the data in this article shows that that's not necessarily the case. The third year of a 4-year US presidential term historically has been by far and away the best performer of the 4. Now, this is statistically significant at the 95% confidence level. In fact, the third years of a US presidential term has produced an average gain in the Dow of 19.4%. And if the Dow can go up 19.4% in 1 year, then the S&P might go up 25 or 30%, and the NASDAQ might go up 30 or 40%. The thing is, the gains in the stock market aren't entirely spread out evenly across the year. It's actually front-loaded into the beginning of the year. Looking at the third year of a presidential term, October and November have historically been pretty good months, up 2.5%. And that's exactly what we saw last year in October and November, nice rallies in the stock market. December's also been up, but not quite as much as October and November, and we saw that also. January's been a massive gainer, and we saw that again this January. February was a bit down, and again, we saw that. Now, the one difference is if you look at February, this February was actually negative. It wasn't positive. So we're already getting a little bit of divergence from this chart, but the general trend has been in place. Now, March has historically been a big question mark. We don't really know if March is up or down. There's really not good indicators one way or the other. But April has historically been an amazing month for the stock market. And then the old saying is sell in May and go away. Now, what's interesting about May is a few economic things that are coming up. This May, the US government is set to run out of money, and that means the debt ceiling is going to have to get raised. Now, it's not really a question of whether or not the debt ceiling will be raised. It always gets raised. The question is when, and sometimes the debt ceiling gets raised after the government runs out of money and there is a government shutdown. And if we get a government shutdown, the stock market will sell off. And that's one of the reasons why some pretty big investors have been loading up on VIX call options for May, expecting the VIX, the volatility index, to skyrocket in May if we do in fact get a government shutdown or any problems with trying to raise the debt ceiling. Now, ultimately, whether the market goes up or down this year is going to be dependent upon the economy. So let's take a look at where the economy stands, and let's start with the housing market. Affordability is hindered with mortgage rates rising for the 4th week in a row, briefly touching 7%. The housing market is flipped, and the first sign of a reversal in prices is here. After months of declining gains, home prices have finally fallen from year-ago levels, and it could be a sign of what's to come. Fairweather expects year-over-year price changes to remain negative for most of the spring. That's the peak home buying season. Mortgage rates are still high, so that's why we're seeing these year-over-year comparisons go negative. And as mortgage rates rise and bond yields increase, Wall Street has conceded that there is finally an alternative to stocks. Wall Street says it's done with TINA, T-I-N-A. There is no alternative to stocks. Bond yields had hit rock bottom. The stock market, especially in the US, seemed to be the best place to seek returns. Then came last year's market sell-off. Stocks slumped and bond yields soared to levels not seen in more than a decade. For the first time in years, things outside of the stock market, including emerging markets, treasuries, and cash, are looking attractive. Goldman Sachs has dubbed the shift Terra, short for there are reasonable alternatives. And Deutsche Bank has endorsed tapas, meaning there are plenty of alternatives. For a number of years, US growth stocks were kind of the only game in town. Now, you can actually get a yield on fixed income. Many maintain that stocks look less attractive than other assets. Earnings, which investors consider one significant driver of stock gains, have begun to fall. Companies in the S&P 500 are projected to have suffered a 4.6% decline in profit in the fourth quarter of 2022. That would mark their first drop in earnings since the third quarter of 2020 during the COVID pandemic, and analysts are also expecting S&P 500 earnings to decline in the first and second quarters of 2023. And despite the sell-off we've already had in stocks, US stocks still don't look cheap. The S&P 500 is trading at about 17.5 times its next 12 months of expected earnings, above the 10-year average of 17.2. Amazingly, that 10-year average of 17.2 was during one of the longest bull runs in history. The historical market average is only 15. Multiples have not adjusted to this new reality of declining earnings. And price-to-sales ratios are actually at one of the highest levels in history, pointing to the stock market actually being at one of the most expensive levels in history. It's difficult to justify paying a premium for stocks that carry the risk of losing money when investors can lock in credit market yields ranging from the mid to high single digits. Now, ultimately, whether stocks go up or down this year is going to be dependent upon how the economy holds up. And right now, it's difficult to know just how well the economy will hold up. If there is a soft landing, like bulls expect, then US equities could go up another 10% this year. But if we slip into a hard landing, a major recession, like bears think we will, there could be easily a 20% downside in the stock market. So are we going to have a major recession like bears think, or are we going to avoid one and have a soft landing, or maybe even no landing like bulls think? Well, so far, bulls are winning because the US economy remains quite strong. Cuts at Amazon and other tech companies don't spell a recession yet. Still, slowing corporate profits and rising interest rates are warning signs of possible problems in the future. When the US has entered recession in the past, weakness has often started in one sector and then spread like wildfire, pulling down a widening array of industries. And more cuts could be coming as tech executives trim costs in response to the pressures on their bottom lines from investors. Profits of tech companies in the S&P 500 in the fourth quarter were down 8.4% from a year earlier, the worst performance since 2009, the great financial crisis. Yet, as bulls point out, the latest readings of the job market suggest that the broader US economy is still growing at a healthy pace. But one thing we have to understand about the strong job market is that the growth is not even. Bars, hotels, and restaurants have become the economy's fastest growing employers. But the problem with these sectors is that they don't pay as well as a lot of the full-time jobs from Amazon and other tech companies. In addition, a lot of these jobs are part-time jobs, so they don't even make up the same amount of income. And this is one of the reasons why we've seen the number of hours worked start to increase, while we've also seen the amount of money workers are making per hour start to decrease. Because these jobs don't pay as well, so the amount of money people are making is decreasing, and a lot of people are going out and getting second jobs in these service sectors because their full-time jobs no longer provide enough income for them to pay their bills. And so we're not necessarily seeing a strong labor market, like really low unemployment due to the fact that there's a lot of full-time jobs out there and everything is great. We're seeing this because people are going out and getting 2 and 3 part-time jobs in order to pay their bills. And unfortunately, the long, robust U.S. labor market is starting to show signs of cooling down. Figures from ZipRecruiter and Recruit Holdings, 2 large online recruiting companies, show the number of job postings on their sites declined more late last year than the Labor Department report on job openings for that same period. Postings in retail and travel were 25% above pre-COVID levels in February, and government job postings were 54% above pre-COVID levels. Now, this is one of the reasons why we see the private payroll data differ from the official government data, is because a lot of the job gains have been in the government sector. As Congress printed money last year in order to provide their infrastructure bill and other investment bills, this caused a lot of jobs in the government sector to start to open up. And that's one of the reasons why we are seeing strong government job data, even though we're seeing weak private job data. The problem is strong government job data does not help company earnings. And so the weak private jobs data could indicate that earnings are going to continue to decline and stocks could decline as well. Another problem is that the reliability of the Labor Department's job openings estimates has declined in recent years because fewer businesses have been responding to survey questions. The response rate for the survey fell to 30% last September, down from 56% in February 2020. Now, as bulls have pointed out, the strong job data points to the fact that the world economy is doing well. But as bears have pointed out, this is bad news for central bankers. The resilience in the world economy may persuade central bankers that they need to raise key interest rates further than anticipated in order to cool inflation. And this could translate into a slowdown in growth later this year and into 2024. And even U.S. Federal Reserve officials say that hotter data will warrant higher rates. So whether the stock market goes up or down this year is going to depend upon how the U.S. economy performs. And this week, we have a lot of economic data coming out that might give us some indication whether we are going to avoid a recession and continue into a bull run, or if things really are slowing down and we might actually get that recession that bears think we will. The biggest things coming out in the economy this week include Jerome Powell speeches and some jobs data. On Tuesday, Federal Reserve Chairman Jerome Powell testifies before the U.S. Senate Committee on Banking, Housing, and Urban Affairs. And on Wednesday, Powell testifies before the U.S. House Financial Services Committee. Now, in the past, Jerome Powell has been dovish when he's speaking to Congress and the Senate because his job is on the line. And the Congress and Senate want Jerome Powell to fix the economy, do things well. So he's essentially going to tell them whatever they want to hear, not necessarily the truth. And this causes very often a very dovish outlook to come from Jerome Powell, which can cause the stock market to rise. So Jerome Powell speaking on Tuesday and Wednesday could actually be bullish for stocks. Now, on Wednesday, we also get the Commerce Department reporting on U.S. exports and imports, which will give us a little bit of insight into where GDP might fall for the Q1 of 2023. Also, the Labor Department releases its January job data on job openings, quits, and layoffs. Then on Thursday, the Labor Department reports the number of worker filings for unemployment benefits for the week. And then on Friday, the Labor Department reports the state of the U.S. labor market in February, including the level of payrolls, unemployment rate, and the average weekly earnings. Remember that January's job report was extremely strong. So we are really going to have to take a look to see how February's job report was to see if that strength continued or if it weakened a little bit. Now, I don't have enough time to go over all of the economic data that you need to know for this week in this video, so I suggest you go sign up for my free weekly newsletter. This newsletter gets sent out every Monday morning and includes all of the things that you need to know before the market opens on Monday. I go over a lot of the technical analysis in this newsletter, as well as the market sentiment and some economic data. If you want to know everything that you need to know before the market opens on Monday, make sure you go sign up for that free newsletter at stockcurry.vip/newsletter. That's stockcurry.vip/newsletter. If you got a lot out of this video, then be a good friend and share this video with your friends and family so that they will know what's going on in the market as well. And don't forget to hit the like button and subscribe. And if you want to know my technical analysis and where I see the market going from here, make sure you watch the last video that I uploaded here.